So you're telling me I give you $10,000 and over the course of 12 months, you're going to allow me to borrow $5,000? Who's doing this? Who's doing this? Who's doing this? Finance for the everyday millennial. Hard charging solutions. We provide an accelerant in the journey towards financial independence. All right, everybody. Welcome back to another episode of Cassian with Cassian. I'm your host, Cassian Nuñez, and today I am coming to you with my reaction to a whole life insurance video that someone, a member of my team, sent to me and said, hey, what are your thoughts? What are your opinions on whole life insurance? And so instead of just giving them a response to their question, I decided to create some content out of it. So we're gonna go ahead and watch just a few minutes of this video and get my reaction based on the information that we hear. I wanna start off by saying I do not know the woman in the video. Sorry to this woman, I do not know this woman. I'm sure she's a great person, but I already know what we teach at RINO Invest in terms of life insurance and how we view it. And so I'm interested to hear what she has to say, but I do have some preconceived notions going into it. But let's see what she has to say.
If you think you're just going to leave your life insurance policy to the next generation, you are using it incorrectly. By the end of this video, I'm going to teach you how to use your policy to grow wealth and sustain it today. By the way, my name...
Right there, I can tell you that if you're going to leave wealth for your family and create generational wealth, legacy building wealth, life insurance is probably the worst way to do it. But we'll see. Let's go.
My name is Carmen, and go ahead and subscribe to our channel and hit the notifications bell so that you're notified every time
we did go ahead and subscribe because I'm not a hater. I am going to go ahead and support her. She probably has a bunch of really great content. This probably, isn't the best piece of content that she's produced, but we're going to go ahead and subscribe, support, because that's what YouTubers do. We support each other.
Post new videos. All right, let's go ahead and jump into the points for today. So every single time you pay your premium or the fee for insurance, there is something that grows inside of your policy, and that is called cash value. Now, why is cash value important to you? Because it's cash that you can use at your discretion. And when you
You know when else you can use cash at your discretion? When it's in your checking account. That's also when you can go ahead and use it at your discretion. No need to take your hard-earned money and pay it in forms of premiums to a life insurance company to borrow it from them. You could just keep the money, but all right.
Access the funds, you don't have to pay any penalties the same way that you would with retirement.
Fun fact, there's no penalty for taking cash out of your checking account.
Accounts. So if you go to the bank, you have to request the money, you have to apply for it, you have to pay, you have to fill out 10 pages of forms just to be able to ask for the money. In a retirement account, you're going to be taxed and penalized with a whole life insurance policy.
Depending on the retirement account, there's a whole lot of stuff there, but depending on the retirement account that you have, that's not exactly true. Right? We know if you go and look at my video where I talked about the difference between a traditional and a Roth IRA or 401k, which is an employer-sponsored plan, by selecting the Roth account or the Roth feature to your retirement account, you are allowed to withdraw up to $50,000 for employer-sponsored plans or up to the amount of money that you initially invested and continue to invest if you are dollar cost averaging into your account, which you should be doing, completely penalty free. The penalties are kicked in based on the amount of money that that account is growing. So if you put in $100 and then in 1 year you have a 10% return and now the value is $110, you cannot pull out the full $110 because you'll be penalized on the growth of the account. But you can pull out $100 or the amount that you put in that grew by 10%. That is an awesome feature of the employer-sponsored or the individual retirement account, just as long as it's Roth. So that's not entirely true, but okay.
policy, there is none of that, right? So that's one of the biggest perks that I would say that I love about life insurance. Now, how does this cash value grow? Every time you pay your premium, as long as you are working with a life insurance agent that knows how to design your policy appropriately, you can accelerate the cash value growth inside your policy to be able to obtain cash in the very first year. Let me give you an example. Let's say that your premium, the fee for insurance, is $10,000 a year. And conservatively, let's say that we design a policy for you where you receive 50% of your cash available in the first year. So 50% of $10,000 is $5,000. Now, you have $5,000 that grows.
Wait a minute. So you're telling me I give you $10,000 and over the course of 12 months, you're going to allow me to borrow $5,000? Who's doing this? Who's doing this? Who's doing this? Oh my God.
That grows inside of your cash value, and the remaining $5,000 has been applied to your death benefit. Remember, this is life insurance, so you're not going to have all of your money available inside the cash value because we do have to pay for life insurance. So let's talk about.
That's a good point. All right, so if you have $5,000 going toward the cash value account, and then you have $5,000 going towards the death benefit, you do have to pay for that. A service is being provided. Hopefully not, because you're alive. But let's say the death benefit is valued at $1 million. I can tell you right now, there are several options where the death benefit being $1 million is not going to cost you $5,000 a year to purchase. And so where is this difference going, right? If you are being charged $5,000 by one of these whole life insurance providers to pay out a $1 million death benefit in the event of your untimely demise, and you're charged half of that, on average, it's about 50% of that, if you were to go and just get a term life insurance policy, where's that other $2,500 going? I'll let you think about that.
About how you can utilize the cash value to your benefit.
All right, the answer is insurance agent fees. So whoever put insurance agent fees down in the comments, you win, 5 gold stars for you.
First few perks that I want to make sure that I mention is that the cash in your life insurance policy grows at a tax-free rate. And the reason why this can grow at a tax-free rate is because you're using after-tax dollars to pay for your life insurance policy. Next is the guarantee.
You know where else your money grows tax-free because you're using after-tax dollars? A Roth retirement account. Individual or employer-sponsored. Roth. After tax.
Signing our contract, because that is how the life insurance policy is designed. Now, this is very important to us because as opposed to using a savings account where the same rate isn't 4%, we love the fact that we are at least earning 4% in our cash value so that our money can continue to grow at a compounded rate without us having to do
4%. If you're comparing your whole life insurance cash value balance to a savings account, which is giving you a fraction of a percent, sure, 4% seems great. If you're watching this shortly after I created it, which is in July of 2024, then we're still dealing with inflation. The Federal Reserve is still trying to figure out if they want to cut rates from 5.5%, right? So I don't know that I'm getting out of bed for 4%, especially when the alternative is the S&P 500. You can just invest in the S&P 500 index fund. You can dollar cost average into it. It's averaging from 10 to 12% over the last 30 years. And so the opportunity cost is astronomical. The fact that people are looking at insurance as an investment instead of what it's actually supposed to be used for, which is to mitigate risk, right? To protect your loved ones in the event of your untimely demise by providing income to them until they can get on their feet and provide the income for themselves. That's what insurance is for. It is not for investment. You just heard it. It's about 4%. I have heard some policies providing as much as 6%, but that still pales in comparison when you look at the alternatives, the S&P 500 or the stock market in general.
Anything. Now, it's important for you to know that there is nothing that can out-earn tax-free compounded interest, which is why we say sayonara to our own savings accounts, and we utilize the cash value inside our life insurance policies to make investments and to grow even more money, because we understand the system that we have available to us with this asset in whole life insurance.
So she's being very savvy here, right? She keeps saying save, save, save. She started the video by saying you're going to grow legacy wealth, generational wealth, right? Most people do not save their way into that. They invest their way into that. And so I don't know. I feel like there's a little bit of a discrepancy between the beginning of this video, where we were thinking that this was going to be some awesome vehicle to get us to generational wealth, which is a massive amount of money necessary, right, to be able to fund, not just yourself but your posterity, and saving. That's not really what we came to this video to consume. At least I'm assuming that's not what most people came to this video to consume. The title says how to use whole life insurance to get rich. Most people don't save their way into riches, right? They invest their way into it.
So I would assume the next question that you're going to ask me is, well, Carmen, how do I access the money to invest and to take advantage of opportunities? Well, how Darius and I prefer to utilize the money inside of our policy is we get a loan. Now, why is a loan important? Because of what I was just saying. We love the fact that our policies grow at a compounded rate. And if we were to withdraw the money, meaning take the money out of our account, that is going to affect the compounded rate, and it's going to affect the growth of our policy, right? So we don't want to touch that. So we request a loan from the life insurance company, and literally all they're doing is looking at the money that is available to us, and they're giving us their money instead so that we don't affect the growth inside of our policy. And the life insurance company gives us a loan, and they collateralize our death benefit. So if you put this into perspective, let's say that our death benefit is $500,000, and at the time of our passing, we owe $20,000 on a loan. Then they will deduct the $20,000 and pay out $480,000 to our heirs because we had an outstanding loan. And this is an amazing way to not have to pass on debt to the next generation. So let's review. We talked about compounded interest, the tax-free.
Another way to not have to pass on debt to the next generation is to invest for the next generation. You can do that with our preferred investment of choice, which is real estate. If you'd like to know more about that, please leave a comment in the comment section of this video. You can also go to rhinoinvest.co and become a client, or you can go to cashinwithcashin.com to increase your financial literacy and IQ. I'm going to tell you right now, we have about 4 more minutes or so of watching this video. I don't see how we're going to get there in terms of life insurance being able to be invested in such a way that's going to generate massive amounts of riches and generational wealth. But I just gave you the answer right there. Real estate is the #1 asset class, followed very closely by securities.
Now, I want you to think about the fact of being able to grow your cash value, continuing to keep the money inside your family because you're getting loans from your policy and paying the principal and the interest back to your policy. Imagine the growth of that over your lifetime, because right now you're probably going to the bank and getting loans for your cars, your houses, you're using your credit card, you're getting personal loans, and you're paying all of that money to the bank. All of the principal and interest is going to the bank and not going to your system. So just with a little mindset shift and understanding how to utilize the whole life insurance product as your own asset or as your own banking system, every time you get a loan, you have the ability to apply those same principles that you already understand from the bank and pay yourself, meaning pay the policy back, all of the principal and the interest into your policy in that compounded rate environment. And that allows your policy to grow exponentially and continue to keep the money inside of your policy. And if you apply those same principles to your family, teach them how to use this same system, imagine the wealth that can accumulate with your family, especially when the death benefits.
Do is imagine the wealth that's been lost. Massive amounts of wealth is being lost by people continuing to purchase insurance as an investment. It is not an investment. It is a massive opportunity cost. Massive.
are passed to the next generation. Something that comes up a lot on our channel is people ask, well, Carmen and Darius, can I get the cash value and the death benefit? And I think it's important that I address that. And the answer is no. The reason why you have cash value in the first place is because a life insurance company is literally siphoning pieces of your death benefit to you while you're living. What does that mean? Is they are allowing you to utilize.
Okay, she was honest about that. I've seen a lot of videos that say you can get the death benefit in addition to the cash value balance that is accrued over the course of however many years that you're paying your premiums. That is not accurate. So if you see videos out there on whole life insurance that are saying, depending on how the insurance agent sets it up, you too can get access to the death benefit and you can get access to the amount of money that's in the cash value account. It's not accurate. And so she told the truth here. 2 gold stars to her. And we're going to like the video. We've already subscribed. We're going to like the video now.
Your death benefit right now, as opposed to you having to die and your heirs being able to use it. So the only reason why you have cash value, again, just to recap, is because you are using your death benefit right now. And that's why when you pass, there aren't 2 buckets of money. At the end of the day, it's just 1 bucket of money, and that's your death benefit that the life insurance company is allowing you to access. Okay, so that's really important that you understand that, because what other assets do you know that you can grow your money in a tax-free compounded environment and be able to keep all of your money in a closed system, which is why we wanted to come today and share this.
Literally, the answer is a retirement account with a Roth feature, an individual retirement account, Roth, or an employer-sponsored plan. Most people will have a 401k, or if you're a public employee or employee of a nonprofit, a 403b. If you're a teacher, you have the combination of a 457 and a 403b. Very powerful. We have a video on that as well. But if you have the Roth feature attached to a retirement account, you get all of these benefits, minus the death benefit, of course, but you could just purchase that with term. And there's no penalty. And you are able to invest your money in a way that you think is best in terms of growth. On the individual side, you definitely can do it. And with a lot of employer-sponsored plans, you can do it. So I have a video out on the thrift savings plan, and more specifically, the mutual fund window, which shifted this massive employer-sponsored plan provided to public servants and members of the military, where they are now able to invest in a bunch of different index funds. That was not available to them at a time. We only had, or there was only the SCI, G and F fund, and then life cycle funds. Now we have the ability to go into the TSP, the mutual fund window is what it's called, and you can invest in a bunch of different opportunities in securities. And a lot of major corporations are moving to this as well, where their IPS, their investment policy statement, isn't as strict or as stringent as it used to be. And ERISA is allowing for this. There's been a couple of changes in the law. We'll be coming up with some more content and presenting that to you shortly. But you can do this. You can do this in a retirement account. You can do this in an individual retirement account and in a lot of employer-sponsored retirement accounts. You do not need to be engaged in whole life insurance to get rich.
Information with you, because we really love being able to use whole life insurance specifically as our asset to fund investments, to allow it to be the seed money that we need to make more money. Because at the end of the day, if
investing in life insurance so that you can use your cash value account to invest in investments.
Just buy a whole life insurance policy and sit on it, we don't believe that's going to be the best opportunity for you to be the hedge against inflation. But if you utilize your whole life insurance policy and then use it to invest, because you're already earning compounded interest and you're earning more money outside of the policy with whatever those investments, and you pay it all back to your policy, that just explodes and compounds amazingly. And the other thing to note is that the stability and the protection that the life insurance policy provides you is really what we're doing this for. Because we want to make sure, for myself and Darius, that our families are always covered should something happen to us. And the fact that we have a guaranteed contract.
Get term life insurance. I am not poo-pooing life insurance, right? It's the type of life insurance that people are purchasing. Term life insurance is definitely a part of anybody's financial plan. At least it should be. It's a very integral part too, because you have to mitigate those risks. Completely understand the importance of insurance and good insurance planning. And every single client of RINO Invest will have the appropriate amounts of insurance: life, health, auto, property, etc., disability. Whole life insurance, no bueno.
That is going to sustain the test of time is one of the most important things for us, and the reason why we have multiple life insurance policies. So if you want to be able to do the exact same thing that we're doing, grow your money in a tax-free compounded interest rate, then go ahead and click on the link.
Okay, so I hope we learned a lot today. This thing called financial advice, this arena of a financial advice, and how people get their information: TikTok, Instagram, YouTube, the news, whatever. It's very complicated, and it makes folks in this profession that have a fiduciary responsibility, like I do, it makes it very difficult for us to kind of parse through all of the noise that's out there and actually get to the folks that want good, sound financial planning advice. And so what I just want to leave you with is, if you can't really understand what it is that's being explained to you, it's not because you're slow. It's not because you're not well versed in personal finance. It's not because you don't have your series whatever, or that you didn't go to school for financial planning. It's probably because it doesn't make sense. Money is not very difficult. A majority of good financial planning comes in the form of changing behaviors. It's not really a massive math problem, not until you get into the millions of dollars, and then you have to really be careful about how you're engaged in tax planning. You have to be really, really careful when you're setting up your estate, your trust and your wills and things like that. But not until you're way up there in the millions of dollars, which I'm sure everyone who's watching this channel will one day be there, do you have to worry about the intricacies and the complexities that come with financial planning. Most folks, if you have the right type of insurance in terms of life, it should be term, right? Some sort of a disability policy that makes sense for you. As long as you have health insurance, auto insurance, property insurance, whether that's rental property insurance or homeowners insurance, you're going to be fine mitigating your risk and then spending the extremely lower premiums that you're going to have to pay to have those policies versus the higher premiums that you would pay if you were to purchase a whole life insurance policy. And take that difference and just dollar cost average into the S&P 500. Do not overcomplicate this, right? Do not overcomplicate this. And so with that, I really appreciate you all for watching. And just remember that it is always a great time to invest in real education, invest in performing assets, get rid of bad debt, and provide oversight for those assets.